Welcome to Inside India. I'm Amitod Singh, and these are your headlines. The Nifty struggling to break past that 26,000 level. A lot of volatility as we've seen some big IPO moves and with concerns about valuation still swirling. Those concerns keeping Wall Street down for another day, with all eyes on the $5 trillion company NVIDIA as it reports later today. A topic that will be hot at the Morgan Stanley APAC Summit right here in Singapore. Martin Soong is on the ground.
Good morning, Amitaj. You're absolutely right. You know, Indian investors, I know, institutions, also retail investors, punters love to trade the U.S. market. And NVDA earnings drop tonight, Asia time, are going to be crucial. 8% of the SPX. So we'll be talking to Michael Wilson, Morgan Stanley's chief U.S. equity strategist, also CIO, about that and a lot more coming up in just a bit.
Yeah, we'll come to you in just a bit. Thanks so much for that. Now, India's Commerce Minister, Mr. Piyush Goyal, he will be leading a 100-strong business delegation to Israel in a bid to boost trade ties. We're watching that too. All right, getting started with a look at the Asian markets. A choppy session after Wall Street's decline. Take a look at what's going on. The Australian and the New Zealand markets muted, but slightly negative. Just in the last couple of minutes, we're seeing a shuffle between red and green on this board. The technology sector really, making things slightly difficult when it comes to the positive territory, with South Korea's index heavyweights Samsung Electronics and SK Hynix falling considerably earlier. And Hong Kong-listed shares of Chinese tech company Xiaomi also fell more than 4% after the company on Tuesday warned of higher smartphone prices in 2026. So it's really, the focus is really on the AI valuations, the tech sector. And as you can see, just as I've been speaking, a couple of markets going red, then going back to green. We're watching this very closely, how things play out. Now, the Indian markets coming online in about 45 minutes. Here's what GIFT Nifty Futures is indicating. Take a look at that. Remember, Indian equities slipped on Tuesday, with the Nifty snapping a 6-session winning streak. Perhaps the index's weekly expiry kept traders on the sidelines, and this despite reports suggesting that discussions on a potential India-US trade agreement are nearing completion. But take a look. It's going to be muted most likely, and we could see it once again hitting that 26,000 number. But who knows? A lot is changing. It's muted. There are a number of developments coming in. And when it comes to the US dollar and the Indian rupee relationship, the dollar slightly stronger, but the rupee making sure that it's not hitting that record low in the range of 88.8. All right, a quick check on what US futures are indicating after we got a weak lead from the Wall Street overnight, with the S&P 500 losing for the 4th straight session, its longest slide since August. The Dow was down 1.07%, the Nasdaq leading losses at 1.21%. This is concerns around tech and valuations crop up ahead of NVIDIA's earnings due after the market close on Wednesday. But the rush into AI investment shows no signs of slowing. Microsoft announcing a strategic partnership with NVIDIA and OpenAI rival startup Anthropic, reportedly driving the Claude developers' valuation up to $350 billion. CNBC's Steve Kovach has the latest.
Microsoft's getting into the mega AI deal game, the software giant announcing Tuesday at its annual Ignite conference. It has a new deal with Anthropic, where Anthropic will spend $30 billion on compute with Microsoft and NVIDIA. In turn, Microsoft will invest up to $5 billion and NVIDIA $10 billion in Anthropic. A source tells CNBC that new round of funding brings Anthropic's valuation to $350 billion. The deal extends what Microsoft's been working on for the last few years. Even though Microsoft's a major investor in OpenAI, its Azure cloud runs AI models from just about everyone. That means xAI to DeepSeek to Meta's Llama and now Anthropic. It's also another sign of the slow split between Microsoft and OpenAI after the two companies renewed their agreement earlier this month. Microsoft will start using more Anthropic technology in its own products. It's even using Google's Gemini AI in some cases now. The other major announcement out of Ignite, an AI tool called Agent 365. You can think of that as a dashboard that controls all the AI agents deployed across your company. But while Microsoft is seeing growth in its cloud business thanks to artificial intelligence, it still needs to sell more consumer-facing products like Agent 365, Copilot, and all the rest to justify its massive CapEx spending on artificial intelligence. For CNBC Business News, I'm Steve Kovac.
Now we're going to dive straight into this particular news. Let's head out now to Morgan Stanley's 24th Annual Asia Pacific Summit happening right here in Singapore. Martin Sung is on the ground leading our coverage from there. Great to see you out and about, Martin.
Thank you, Amitav. Good morning, and good morning, folks. Inside India viewers. So you were just talking about that Anthropic, Microsoft, NVIDIA deal. AI is a huge part of the conversation down here at the Morgan Stanley Asia Pacific Summit this year. And don't forget, we've got NVIDIA earnings dropping tonight, Asia time. There's going to be a lot of focus on that number. It's probably the last big catalyst or potential catalyst for the market before we wrap up 2025. Let's bring in someone who knows a little bit more than a little bit about all of this. Mike Wilson joins us now. He is Chief U.S. Equity Strategist, also CIO at Morgan Stanley, and joins us now live. Mike, great to see you, and a pleasure having you on the show.
Thanks for having me. Good morning.
Yeah. So the NVIDIA numbers, right? This is 8% of the SPX. Hugely important. What are those numbers going to turn out to be like, do you think?
Yeah, I mean, I think everybody's fairly constructive. They're going to beat the forecasted estimates. I mean, if they don't, it'll be a disaster, but that's not our view. They're going to beat the numbers. The real question is, how does the stock market react to that? You know, that's the key for markets is it enough to keep the momentum going? And look, we've been in a correction for, I would say, 6 weeks or so. The AI stocks have kind of come off, and we were actually looking for that because the liquidity picture is a little bit less robust. And there's questions now around some of the circular spending, et cetera. That correction we think is ongoing, but it's a correction. It's not the end of the AI cycle. So whatever happens tonight is, if it's a blip, is a pullback, it's probably a dip to be bought. But I think we are in the midst of somewhat of a correction right now.
Okay, so if we do see a blip on the back of NVIDIA's numbers, what you're basically saying is, look, it is just that, right? We're not talking about, the dot-com bust. We're not certainly talking about, as some people are, drawing comparisons with 1929.
Well, I don't know about 29, but let's just talk about 99, okay, because that's probably the better analogy to this tech spending cycle. Look, all of these spending cycles end up, leaving some malinvestment. There will be malinvestment, but then there'll be massive productivity on the back of that spending. The question everybody's asking now is not whether that's going to happen. Is this the fifth inning or is it the ninth inning? Okay, I tend to think it's more in the middle inning, simply because the credit part of this spending is just beginning. Meaning we're just starting to raise money in the credit markets. So it's not like that market's going to that money's going to sit there and they're not going to spend it, which means there's probably time on the clock with these intermittent kind of pullbacks, like we had last year. Quite frankly, we had a pretty good pullback earlier this year.
What are you telling investors, though, and also clients? I mean, should we be worried that we're seeing some of these hyperscalers now funding through debt as opposed to through free cash flow? I mean, free cash flow, I guess there's not much more they can go. The average is about, I think, 60% of FCF. Names like Amazon are up to 70% of free cash flow funding their CapEx ramp. And now we're turning to debt, with problems emerging, if I'm not mistaken, at names like Oracle.
Yeah, I would say it's not a problem as long as the funding markets are there, meaning they're raising the debt, no problem. I mean, there's investors lined up. So it becomes a problem when there's no more debt buyers or people who want to support this kind of spending. We haven't seen that yet. In fact, it's the opposite. We're seeing these companies come to market and raise money in the debt market quite easily. So I think that's a positive for that 9-inning game, if you want to leave it that way. But I think we are in the midst of a kind of a reset on the near-term expectations. Okay.
So I got to ask you here, as far as the trade itself goes, we've seen the last 2 weeks things are softening. Folks are thinking maybe AI is not the only trade in town. You still believe in it? Even if the numbers disappoint out of NVIDIA, it's just a blip. You have come out with a new target for the SPX, S&P rather, 12 months out, 7,800, which puts us about, 19% higher than where we are now.
That's right. And it's, 6,500 was our target for this year. That's looking fairly accurate at this point. We'll see how the year closes. it's not going to be a straight line to that 7,800. But the big story, or the big call that we've had, I think is different, is that we do think it's going to broaden out. Inflation will come back next year, which will drive earnings growth across the S&P 500. So it's not one or the other, Martin. It doesn't have to be at the exclusion of the Mag 7 or AI stocks not working. It's more that the AI investment can lead to more earnings across the S&P 500. And this idea that we had what I would call the end of a rolling recession in April. That's a differentiated view that we've had for quite a while, that April marked a low, a trough for that rolling recession, that we're actually now into a new economic cycle, a new earnings cycle, and all we're waiting for now is the Fed to get ahead of the curve.
So let's talk about that, right? How many cuts penciled in?
So we have 3 penciled in between now and the middle part of next year. That's kind of in line with what the street is kind of pricing right now. That would be disappointing, I think, to the equity market. I would be surprised if the Fed doesn't end up cutting more for reasons that people aren't talking about right now. Okay, the first reason, of course, is that the jobs market has been weaker. The economy kind of needs a little bit of a kick. Okay, the other reason they're going to be cutting, in my view, is that the government needs help funding the deficit. Yeah. Okay, and I think there's this view out there that the Fed is completely independent, that they operate over here in this little silo, and now there's concern about, the White House is having too much influence. I mean, this is not a popular statement, but the Fed is not independent in the sense that it does have an obligation to help Treasury fund the government. And so part of that is cutting rates. Another part of that is actually also providing liquidity in the balance sheet. That's another reason why we're having a correction right now. Right? The market, there's tension in the market now between the Fed cutting and how fast they're cutting. The market wants more cuts and they want them faster, and the market also wants more liquidity, and the Fed has been kind of slow in providing that. My view is that they're going to catch up to that pretty quickly in the next 2 or 3 months, and that will be when we start to see the broadening out in the equity market.
Well, would you agree that the main motivation for the Fed is more keeping funding costs for the debt low or lower, as opposed to helping out a weakening jobs market? Because you cut the price of money, etc., rates lower. That supply side, does that really help on the demand side? It's a people problem, right?
Well, I mean, the issue right now is that the government has just borrowed too much money. Okay, there's too much debt on the government's balance sheet, which is why I think they are running the economy hotter than normal. They're trying to get nominal GDP up, call it 6-7%, through both real growth and inflation. And in that process, the Fed has to be willing to tolerate higher inflation, just like they did in 2021. So this is not by mistake, and it's not a partisan strategy. The Democrats did the same thing. They were also trying to run the economy hot through higher immigration and higher inflation. This time, now with the Republicans, they're trying to do it not through the immigration channel, but through higher productivity, through higher investment, and then also through inflation, through the wage channel at the low end. So these are different policy kind of features, but the same goal. Got to run the economy hot. Got to try to grow your way out of the debt problem.
Okay, how are you thinking about politics and policy, right? Because we're probably about, a year, 12 months away from the midterms next November, right? And we've seen what happened with some of the gubernatorial races just a couple of weeks ago.
Yeah, so I think the number one issue right now for the Republicans is affordability, right? I would say on most metrics, I think the Republicans have delivered on what they promised in the election in 2024. Except for affordability, and we saw that across the board in some of the elections, in the governor elections, and some of the state elections, and so that's what they're focused on now. I mean, one thing about President Trump is if there's a hot button, he tries to deal with it immediately. So you've seen him sort of back off on some tariffs around food, and I think the big one's going to be housing. Can they get housing affordability down or not? I think if they don't, it's going to be tough in the midterms. If they do, I think the Republicans will do quite well.
Right, you're an equities guy. Always competition from the folks over in the bond market, right? We've got the 10 at about 4%-ish. I think we had a high about 4.17 a couple of days ago. As long as we stay below 5, we're okay? Equities are okay?
Really, it's 450, and we've identified that level in the past. Like at 450, that's when the correlation between stocks and rates goes negative, meaning higher rates means lower equities. If rates are around 4, that correlation is still positive. So I do think rates need to be lower for housing to start to see activity. Our housing strategists think 550 on a 30-year mortgage is kind of that magic number. So we're probably still 50 basis points or so away from that. Yeah. There's also policy changes that could come through. Mortgage portability is something they're talking about. 50-year mortgages to kind of get their payments down. Yeah. So they're they're going to do something creative. I don't know what it is yet, but my guess is if housing is going to be a big story in 2026.
Okay. You still like tech, but you're looking at the other 493, looking at things like consumer discretionary, et cetera, as the economy recovers, as you were just describing. What happens with financials and also deregulation? Because one big overhang for the banks, right, for a long time has been the Basel III endgame, whether or not they're going to be required to keep a lot more rainy day money. Obviously, they've been pushing back against that.
Absolutely. I mean, this is one of Scott Bessent's Treasury Secretary's missions, is to get more lending through the traditional banking system, and that's reducing some of the regulations on capital and capital controls. We've also got regulation on M&A. So for some of the capital markets related securities who benefit from M&A or capital markets activity, we're seeing that pick up in spades. So the deregulation is real. It's already starting to hit the financials. And then, of course, this higher velocity in the real economy as rates come down is a straight, benefit to lending from the banking channel.
Okay. Are you, or should we be worried about what Jamie Dimon was talking about not so long ago with the small regional banks, cockroaches emerging?
Well, I would say that's also in the alternative financials as well. So, as you know, the shadow banking system stocks have done much better than the regional banking stocks. And I think a theme for next year is that the regional banking, the regulated banking system, actually stocks do better than the alternative managers. And that's a trade idea I think that is not that popular yet. But if we're right about deregulation, we're right about C&I lending growth picking up, and also mortgages picking up, that's straight into the regulated banking system. So it's an interesting theme to think about, I think, as rates come down.
Okay. My quick last question before I let you go. I know you're very busy. What kind of shape is the U.S. consumer in right now? 2/3, depending on how you measure, 3/4 of the economy. Very important.
No question. I mean, this has been what we call the K economy, right? The upper income consumers have done extremely well. The lower income, middle income consumers not so well. And I think the plan here for the administration is twofold. Number one, it's on the immigration front. So if you think about immigration, who does that hurt the most? It hurts the middle income, lower income consumers because they're competing for jobs now against these immigrants who are also competing for shelter and other resources. So that's one idea that I think is not played through on real wage growth and potentially inflation at the lower end, middle end. You also got to think about deregulation. Deregulation really hurts small businesses. And who owns small businesses but folks in the middle? So there are the policy changes that I see from the administration, I think, are targeted at sort of rebalancing that K economy. And one last comment there. AI is going to suppress wages kind of in the white collar world, which is that higher income cohort. So that rebalancing, I think, is something to look forward to in 2026.
Interesting. Okay. Mike, listen, thank you so much for spending time with us. I wish we had more time, but great to see you. Thanks for dropping by.
Thank you.
All right. We've been talking to Mike Wilson there, Morgan Stanley's Chief U.S. Equity Strategist, also CIO, as our coverage down here at the Morgan Stanley Asia Pacific Summit continues. Amataj, back to you.
Yeah, don't go anywhere. Look at that lineup. We have many more of such guests coming to you through Martin. Martin will be back with us in just a bit. More news and updates also coming up, including a bipartisan push in the U.S. Congress to strengthen ties with India and New Delhi's push to diversify its bilateral trade. Stay tuned. All right, welcome back. India is making a big economic push into Israel this week with Commerce Minister Piyush Goyal leading the largest ever Indian business delegation to the country. Goyal is headed to Israel with more than 100 representatives from India's biggest companies, including Mahindra, Amul, and Asian Paints, along with high-tech, pharma, robotics, automotive, and agri-tech firms. The visit, hosted by Israeli Economic Minister Nir Barkat, is aimed at expanding India's trade footprint, opening new investment opportunities, and pushing ahead talks on a potential India-Israel free trade agreement, which the two sides have been negotiating for more than a decade now. In the meantime, U.S. President Donald Trump hosted a dinner for Saudi Crown Prince Mohammed bin Salman at the White House on Tuesday night. Some of the big names were in attendance. Well, Tesla's CEO Elon Musk, NVIDIA CEO Jensen Huang, and soccer star Cristiano Ronaldo. The event caps off a busy day in D.C. for MBS, announcing a slew of investments and deals. CNBC's Eamon Javers has more.
Saudi Crown Prince Mohammed bin Salman was welcomed by President Trump Tuesday at the White House with a flyover, a military band, and an honor guard on horseback. An elaborate welcome, not a full state visit because bin Salman is not, of course, the head of state in Saudi Arabia, but a full-fledged welcome from this White House for the controversial Saudi Arabian leader. They went into the Oval Office for a session and touched on a couple of important topics, including the president's approval of the sale of F-35 jets to Saudi Arabia. He said those jets would likely be of the same technological capacity as the jets the U.S. sells to Israel. Also, a $600 billion pledge of investments from Saudi Arabia into the United States. The president then sort of teasing Mohammed bin Salman and encouraging him to up that commitment to $1 trillion, which bin Salman then did, saying he sees a lot of investment opportunities in the United States. And then comments about export licenses on chips. The president suggesting that those are still in negotiations as of Tuesday afternoon between the two countries as to whether or not and what level of chip the United States would authorize the export of to Saudi Arabia. The president also using the opportunity to take a dig at Fed Chair Jay Powell during the course of that event, saying that he wanted to remove Powell immediately, but certain people that he would not name are holding him back from making that decision, saying that Jay Powell is simply too late and is dragging the economy down. And a testy exchange in the Oval Office between the president and a reporter who asked him about the Epstein files, the president insisting he had nothing to do with the Epstein files. It was more Democrats who had close relationships, including Larry Summers and others, the former Treasury Secretary, who had relationships with Jeffrey Epstein. The president said he had nothing to do with it. For CNBC Business News, I'm Eamon Javers at the White House.
Right, moving on, an American congressional commission has issued recommendations about tackling competition and threats from China. Elaine Yu has been pouring through this annual report and has the highlights. Elaine?
Hey, Amitash. So the bipartisan U.S.-China Economic and Security Review Commission has urged lawmakers to take strong action in what it called a strategic competition era. It called for setting up a, quote, economic statecraft entity, including various departments, to address national security challenges. It cited China's systematic evasion of U.S. export controls and sanctions, while it says U.S. technological advances are eroding. And this comes as we've seen some reports about the gray area channels, as well as some legal channels that allow Chinese companies to access advanced American chips. And the report also called for Congress to strengthen the ability of the Commerce Department to manage the competition with China, especially when it comes to leading edge AI chips, calling for increased congressional oversight and also requiring tracking for export-controlled advanced chips to detect diversion, it says. And Beijing has previously made noise about any potential security risks with NVIDIA chips, especially naming these potential tracking capabilities. So this is something no doubt Beijing will be watching very closely. The report also noted that China is rapidly advancing physical AI and deploying, quote, autonomous systems at scale, while the U.S. remains mired in pilot programs and bureaucratic delay. So it called for the U.S. to double down on robotics as well. Now, the bipartisan committee also recommended what it called a national goal of a quantum first by 2030 to provide significant funding for the U.S. When it comes to quantum development. So we see, in a way, the U.S. Adopting more of a almost state-driven industrial policy that, in a way, perhaps mirrors China's own industrial policy to compete with that country now. Amitash.
Yeah, the battle is clearly heating up, Elaine. Now, you're also tracking U.S. Confirming a large soybean purchase from China. Tell us more about that.
Yeah, so on the tech competition front, things are heating up, but we do see some trade tensions cooling down now. China has ramped up purchases of American soybeans after a short pause or a period of more subdued buying. So it's a sign that Beijing is keeping up its promises under its trade deal with Trump. Now, the U.S. Department of Agriculture has announced a sale of 792,000 metric tons of soybeans to China for the 2025 to 26 marketing year. So that is a step toward the 12 million tons that the White House said China has committed to buying. So there's actually still a lot more to buy to reach that number. And we also saw soybeans futures falling as traders take profit. So it's a bit of a classic case of buy the rumor, sell the news, as earlier soybeans futures were rallying because there were reports about China indeed buying. Now, analysts have pointed out that China's agreement to buy soybeans now does reflect that these purchases are now serving more political purposes, especially if you consider how for Brazil, it's expected to have another record harvest next year, which will put more downward pressure on American farmers' prices. But for China, if they were to source from South America, that could also mean a longer trade routes and shipping times as well. So we'll see how China does that with its soybeans and if it diversifies. But we do see progress on the trade deal now, Amitash.
All right. Thanks so much for that, Elaine. Coming up, we will head back to the newsmakers we have at the Morgan Stanley APAC Summit. Stay tuned. This is Inside India. Let's get back to the Morgan Stanley Asia Pacific Summit. Martin Sung is joining us live with a very special guest. Martin?
Indeed, Amitaj. Good morning, and good morning, folks watching Inside India. Yeah, we've been having a lot of great conversations down here at the Morgan Stanley Asia Pacific Summit. Our next guest is Sebastian Thrun, and you may remember him. He's been around for a while. He was the founder of Google X, which is the special projects unit of Google. I think you could call it their equivalent of like the Skunk Works, right? Responsible for moonshot projects. Also, the visionary behind Google's first self-driving car project, which morphed into Waymo, and that was about a decade ago. He joins us now live. Sebastian, great to see you and a pleasure having you on the show.
Thank you so much, Martin.
So let's talk about AI first. I know you've been thinking and writing and talking a lot about China AI versus US AI. And just on the surface, one of the ironies I find is China AI open, US AI closed. What does this say about the prospects for success of either model?
It's an unusual situation. Normally we see the opposite. We see US being open and China being closed.
Yeah.
But in this time, China has built some quite amazing models that compete very well with US models. They weren't the first ones to score, but they're the second one to score. And overall, we're just in the beginning. If this is a massive football game, we are still within the first 5 minutes. We had the first few touchdowns.
Okay. Who is likely to score first, using that sports or football analogy? A lot of people think maybe it could be the Chinese for a number of different reasons, right? Obviously, post the DeepSeek moment, it's simply because, they're able to do almost what the West can do, but at a much, much cheaper cost. That's one. And two, obviously, their model is very much top-down and statist. The government is very, very much behind trying to make China an AI leader. Who is going to be able to monetize and commercialize faster, do you think? Is it going to be the Chinese?
I see the two dimensions of competition. One is the competition that's ongoing, where companies try to build the best model and win certain competitions, like, I don't know, the math empiric competition. Those are becoming irrelevant for society, but important for the scientists. And the second is the monetization, getting to the field where people actually use it. And even there, you can see cases where people use AI without the original companies making any money, and some using it with making money. AI is already massively impactful in China and the United States on a day-per-day basis. If you talk to any software engineer, any lawyer, they're using it every day. The challenge is to turn this into businesses and to make real money out of it. And China might win. I don't know.
China might win, but pushback against that would be, and we had this talked about at the fourth plenum up in Beijing not so long ago. Clearly, I mean, they're using the word, and it's a very specific term, the Chinese word for revolution with regards to AI. So they're very, very serious about that. But if you go by the way other business models around EVs, around solar panels, around even textiles have gone in the past for China, the government wants to make China a leader in AI, as they did and are trying to do with the EVs and solar panels and everything else, but they're less concerned about corporate profitability. They're more concerned about bringing the price of AI down and making it more accessible for people and ultimately stimulating consumption. How are you thinking about this?
That is true, and I think DeepSeek is a good example of cleverness to bring the price down, and it's just the beginning. Let's consider this. Training an AI model costs many megawatt hours of energy, like a lot of money, like running a city. Training a human brain costs about $300 of electricity, equivalent if you integrate the amount of power a human brain consumes in the first 18 years of life. So there's a massive gap that has to be bridged yet, and I think no one has discovered it yet. But China's strength, among many others, has been to take technology and ripen it and make it extremely affordable. We see this in AV, in solar panels, and many other domains, and I think in AI will be the same thing.
Yeah. I mean, chips are intermediate, but way upstream, right? The actual critical minerals and rare earths needed. China has a dominant monopoly almost over that. There's one. And two, further downstream, power generation is going to be incredibly important for AI. China produces so much power that it outproduces the U.S. in terms of electricity production 2-to-1 right now. That must be an advantage going forward.
Yes, and it's even worse for Europe at this point. If you go to Germany, power is roughly 10 times as expensive as in China. And it's a bit of a disaster for our European friends because they haven't figured that out. But in China and the United States, the race is on. Again, it's early days, and I think there'll be many winners.
Okay. Now, let's get to what you really are excited about, I know, and that is autonomous. What kinds of strides is China making in autonomous driving with robo-taxis and the like? I mean, I think there's probably a lot more of them running around China than there is in the U.S. right now.
There is. First of all, a big deal now, Waymo, the company I have funded, is certified 100 times safer than human drivers. It's safer, it's greener, it's more accessible, and soon more cost-effective in ownership. I think it's going to change the world just on that basis alone. But China has at least 4 or 5 big companies, Didi, WeDrive, Pony, Baidu, who have cars in production today with actual car ride-sharing services that are unmanned and totally autonomous. And they're doing well, and they're getting better by the day. The West is not paying much attention to it because it's Chinese. But just you wait.
I have to ask you on the technology, right? It's been 10 years since you were at Waymo, but in terms of the technology for autonomous, for self-driving, for robo-taxis, etc., are you more LiDAR or are you more camera sensors?
When you look where I live in San Francisco and open the door, the answer is obvious. It's Waymo and it's LiDAR. And the LiDAR that Waymo uses, the equivalent in China, costs now roughly $200. So the costs have gone dramatically. What the LiDAR gives you is an extra layer of safety beyond the cameras. It tells you how far something is away without telling what it is. So if there's something in front of you, maybe a Martian, like an extraterrestrial human being, it would find it, which a vision sensor can only find today if it's been trained for it. And that ability to find things that's not been trained for is something that gives more safety, and we see it in the numbers. I mean, the only US company that's driving autonomously with a real service, with real passengers and real money making is Waymo.
Wow. Okay. But I think China's not giving up on this. They already lead the world in EVs per se in terms of self-driving autonomous technology. They can do that. That's been proven with all the cars running around in China. As we see names like BYD, we're just talking to somebody from BYD earlier this morning, push outwards away from China because the competition is just so intense there. To try and keep from literally losing their shirts or pants because they're getting crushed at home, market share as well as margins. As they do that, and that technology, the self-driving technology, follows them, right? How under threat are names like Waymo and other Western rivals?
Well, so right now the market is wide open, and we look at the U.S. transportation market, less than 1% is self-driving, much less than 1%. Internationally, in Europe, there's nothing on the streets right now. So there's a massive opportunity. And yes, there'll be competition. I think China has done a phenomenally great job with car manufacturing. We always believe China builds small things for electronics. Now they build bigger things for electronics. Soon very big things like aircraft. Yeah. And that's certainly something where China has a velocity that's unparalleled in the world right now. If I was Germany, if I was Europe, I would be scared of it, much more in the United States.
Goodness, okay. Now, referring to a statistic that you threw up just a couple of minutes ago talking about Waymo, the latest stats are driving around or riding in a Waymo is probably 100 times safer than if you're either driving it yourself or having somebody drive you. What is the equivalent statistic, do you know, for autonomous driving in China, for all those thousands of cars running around?
China offers less transparency in these numbers. We know that the total driving miles are less than Waymo at this point, but the velocity is enormous. We don't quite know the excellent statistics for Chinese cars. We just know it for Waymo.
Okay, fair enough. In terms of these autonomous companies scaling and becoming successful, what is the most important thing for them? Is it the technology? Is it the software or something else?
It used to always be safety. Safety 1, 2, 3, 4, 5. Getting to the point where the cars are so safe that they can't be fooled. And imagine, like, if you have a large language model like a ChatGPT and it makes an error you call hallucination and you shrug. If a self-driving car were to hallucinate, it would kill somebody. It would run a red light. So that level of safety is paramount. We're now at the point where the safety is accomplished, where this thing is just driving and not harming anybody. And now it's going to become scale and cost. Cost is key. We really get to the promise of the self-driving car is that it's cheaper than a human-driven car because we don't need a driver. And that cost has to be amortized and be realized. And Waymo is on its path doing it. Last I checked, they aren't quite there yet, but it's still early days.
So you mentioned the West, including Europe, right, ought to be a little bit nervous given what China has been doing. I mean, for a fact, right now, nobody can produce an EV cheaper than a Chinese EV brand, right? And as we've talked about earlier, right, in terms of AI with DeepSeek, At this stage, it looks as though they're able to do it cheaper as well. I mean, you combine both those things, the platform, the car itself, and then the software, the AI, and there's good reason for the West to be worried, I think.
But look, I'm less worried. I view China as our friend. Last I checked, we consume massive numbers of Chinese goods, and there's a massive interest in going back and forth. It's been a great relationship over the decades. I personally benefit from it. I think we all do. I think these models that are being built want to be open. Whether you lock them up in a box or not, the engineers building them, they go from company to company and they take the knowledge with them. And we see it inside Silicon Valley. We see engineers going from company A to company B. We see it between Silicon Valley and China, companies from Silicon Valley going to China and vice versa. There's now a massive number of scientists in China. There's a bigger number of scientists in this field in China than the United States. So I think the beautiful thing about this technology is very, very open. It's very hard to keep secret. And as it's open in the world, it's just going to spread. The same with these open models from China now are spreading around the world. I use Chinese models in my own company right now because they're better.
Interesting stuff. All right. Sebastian, listen, it's been fascinating talking to you. Thank you for spending time with us. Appreciate it very much.
Absolutely. Thank you.
Right. No, pleasure is all ours. We've been talking to Sebastian Thrun there, who is now, I guess, best way to describe him would be an AI thought leader, as our coverage down here at the Morgan Stanley Asia Pacific Summit continues. Amitash, back to you.
Thank you so much, Martin. Now, before we head to break, India's External Affairs Minister S. Jaishankar met Russian President Vladimir Putin at the Kremlin on Tuesday. State media showed Putin welcoming Jaishankar at the Senate Palace, where the two discussed key regional and global developments. The meeting, attended by senior Russian officials, comes ahead of Putin's expected visit to India around December 5th for the 23rd annual summit with Prime Minister Narendra Modi. We will be back with the market open. Stay with us. All right, welcome back. We're going to take a very quick look at the Indian market open. What does it look like? We have about a minute before the markets open. But at this point in time, the Nifty 50 closing at 25,918. It has been flirting with that number of 26,000 for a while. And what we are seeing across Asian markets is a mixed reaction, a bit of a muted reaction, following what we saw on the US side. The Wall Street really reflecting valuation concerns around whether the Fed will cut rates or not, and whether India will go ahead and actually look at that sentiment and follow that particular trend that we've seen in Asia. Remember, within India, domestically, a couple of different things playing out, a number of IPOs. That's where the action has been. And at the same time, one has been considering how the impact of the tariffs plays into the sentiment of the Indian market. A number of people at this point in time weighing in, perhaps pricing in the idea that there will be a rate cut from that high, really highest in the world, 50%. And as the markets open, what we're seeing is a bit of a muted reaction, but perhaps going down negatively, as we have seen actually in a wider trend in the last couple of days across markets. For the moment, what you're seeing is Nifty 50 down slightly, opening down. Whether that will change, we'll be watching that very closely. The US dollar and Indian rupee, not much change there. The dollar, well, slightly stronger against the Indian rupee. Meanwhile, top oil refiner Reliance has bought 1 million barrels of crude oil from Kuwait, according to trade sources who spoke to Reuters. The move comes as most Indian refiners scale back Russian supplies ahead of US sanctions on Rosneft and Lukoil taking effect this Friday. Reuters reported that Reliance stopped purchasing Russian crude last month and has since turned to the Middle East and the US, buying at least 12 million barrels of spot oil so far. The shares muted, slightly down 0.14%. Also, PhysicsWallah just starting day 2 of trade. Take a look at their shares. Positive. They were positive almost astronomically yesterday. The EdTech firm made a strong trading debut with shares surging as much as 49% on their first day. The rally lifted the company's valuation to over $5 billion. This despite the $393 million IPO seeing moderate demand, closing at just 1.81 times subscription. PhysicsWallah plans to use the proceeds for offline expansion as well as tech and infrastructure upgrades. And it's not just PhysicsWallah that has seen this sort of gain. New age firms listed this month, including Grow and Pine Labs, surged on debut, even as some investors worry about stretched valuations. The parent of Grow, Billion Brains Garage, yes, that is the name, for instance, has almost doubled from its issue price of 100 rupees. IPO filings this year are at a decade high, and by December we could see record fundraising through public offerings. And the momentum continues next year with big names like Reliance's Jio, the National Stock Exchange, and Flipkart preparing to go public. According to Equirus Capital, India could see up to $20 billion raised via IPOs in 2026. And that's why we have Bhavesh Shah. He is the MD and head of investment banking at Equirus Capital. Thanks so much for joining us, Bhavesh.
Thank you, Amito. It's a privilege to be here with you.
Yeah, the pleasure is all ours, of course, and we have to talk about the hot IPO market. Before we get to what's going to happen next year, about this year, 17.16 billion raised by 91 IPOs just this year, we're talking rupees, up to November 17, just shy of the total figure from 2024, 17.95. Now data, this is from the data that we got from the Indian media outlet Mint. And it's fair to assume that another record year is coming and the momentum appears unstoppable, you would say?
So I think, Amitoj, I think let's step back and look at how the Indian capital markets have really transformed over the last few decades. Now, if I really were to step back and look at this century, starting from 2001 to now, the 2001 to 2010 decade, we saw something like 2 lakh crores being raised, which is roughly about, something in the vicinity of about $25 billion in one decade. The second decade, which is 2011 to 2020, we saw a similar number being raised. This decade, which is the first 5 years from 2021 to 2025, we've already seen 5 lakh crores or somewhere in the vicinity of $5 billion being raised in this first 5 years. Now, this is driven by a lot of macro factors and a lot of, capital market changing factors. We had seen a lot of reliance of foreign investors' money coming into the markets in India, but now with the resilient domestic inflows coming in, every month we are seeing almost 30,000 crores coming into the month every month by way of systematic investment in mutual funds into the mutual fund industry, and that money is being being put in the equity markets. We are going to see this trend for a sustained amount of time, for a long period of time. So this is on the demand side. On the supply side, we are seeing some of the best companies raise capital These are very differentiated businesses, very scaled up
Right.
businesses. So, we are looking at this trend to continue for some time.
Okay, so you do kind of feel that this is going to be unstoppable, barring, let's say, a black swan event or something. But given you were, alluding to the idea of what is coming next, I quickly want to get a sense, your thoughts on the recent IPOs. PhysicsWallah, we were just talking about that. Pine Labs, Lenskart, and Grow. But really, it was mixed if you compare all these companies. PhysicsWallah doing great, Grow doing well, but muted for the other two. How do we make sense of this?
No, so I think it's a function of these are first of all very disruptive businesses. They are very large scale businesses, and I think it's also a matter of valuations that some of these companies are able to come up with, and how the valuations are perceived by the investors. I think we are looking at not only these new age digital companies being raising money, but in fact we are also looking at a lot of other companies coming from various parts of India, from tier 2, tier 3 cities as well. I think, on a broader basis, we are expecting, more and more disruptive and more new age businesses and more different kind of businesses, differentiated businesses to tap capital markets in India. And, not going into specifics about the companies that you mentioned, but, some of these companies have done very well. Some of them have done okay-ish. But I think that's a part and parcel of every market, where some companies will do well, some companies will not do well,
Right.
Some IPOs will do well, some IPOs will not do well. But the broader trend is very, very strong from that perspective.
Okay, as I was speaking, we just saw Billion Brains Garage or Grow down about shuffling between 3 to 5% actually, right now 3.32%. I just want to also get your sense on valuation concerns, because you've talked about this in the past. You've argued recently, in fact, that we still have valuation aggression. That's what you called it. But a lot of sanity is starting to prevail. Is India managing to convince the foreign investors about this point?
So I think there are 2-3 angles to this. One is the stock markets and one is the IPO valuations. In my view, IPO valuations are very, very disciplined even at this point of time, in my view. The investors do a lot of diligence. They are extremely disciplined in terms of when it comes to IPO valuations. I mean, we may always see some blips here and there, but in general, the processes that the investors are adopting is very, very robust in my view. My personal view is, I think, as we kind of go along, as far as the foreign investors are concerned, today they have been investing money out of India, they're selling from India and going into markets where probably there are more AI-driven markets. We've seen some of the North Asian markets kind of do very well last year. But as the valuations over there kind of, try to be sober, and and in India, I think the valuations are trying to be, and I think Indian valuations are starting to look more attractive as we kind of go into the next year. We might see foreign investors coming back to India.
Okay, I just want to dive a little deeper into this, double click on this point that you're making, the hope that you have, because for some of the companies, retail participation has been low. Whether that's a concern for you. But more importantly, if I could bring up some data that we've just been gleaning, the BSE gauge of newly listed firms tracking companies for a year after debut has found that the broader market is on course for its first underperformance since 2022. About 40% of the 108 firms in the IPO index trading below their offer price, with a dozen down more than 25%. Now, this is a reportage from Bloomberg. How do you view this particular aspect, given you've said that effectively investing in such IPOs for domestic investors is a step in value creation, and you have optimism that they'll continue to do that?
No, that's a great point, and these are very valid data points. I think one significant area which kind of really drives the valuation after the IPO is effectively the post-IPO performance of the companies. And I think, the IPO just gives a platform to kind of get listed and then value creation. But ultimately, it's the company's business which really kind of is important for it to kind of demonstrate growth from there on. I personally feel we have seen so many companies who have done not so well after the IPO, but eventually, because the stories are strong and because they start demonstrating their performance, we have seen the valuations kind of, come back and kind of, create value for the overall stakeholders. I think it's a journey for all the companies that they have to go through. And I think rather than linking it to it's just the high valuations, which is why they lost money. I think whether the investors make money or not money, they don't make money in an IPO is a function of not only the valuation but also the business and how the eventual performance of the business is going.
Right. Okay. We want to just talk about your report, which effectively has said that, $20 billion could be raised next year. And this is before we talk about individual companies. Give me a sense of this, because this is fascinating. Companies such as Oyo, PhonePe, and Flipkart are expected to anchor the digital economy segment. You also have Jio, NSE, and SBI Mutual Fund. But how do you really separate the buzz or frenzy for companies that people understand easily, retail investors understand easily, versus companies that are not entirely consumer-facing?
So my personal view is, I think the retail investors in India, they are more short-term investors. Some of them could be exceptions. They will be there for long term. But in general, we have seen investors, HNIs in retail, they enter into an IPO with a view to make a short-term capital gains. I think that is what what we have observed. The real analysis and the real valuations and the real kind of process that has been followed is by the institutional investors, and we are seeing that a lot of activity around that. Mutual funds, banks, FIIs, AIFs, insurance companies. They are the ones who spend a really good amount of time, whether it's a consumer-facing business, whether it's a non-consumer-facing business. They have full analysis to understand the business. And my urge to retail investors would be to kind of rather invest through portfolio managers or fund managers rather than taking their own call.
So we're completely out of time. Thanks so much for that, Bhavesh Shah from Equirus Capital. That's all the time we have today on Inside India.